Onto your markets news now. Asian markets were generally positive, although the Shanghai Composite Index in China ended down. A positive session in U.S. markets fueled sentiment, especially as U.S. data seems to suggest that the possibility of U.S. interest rate cuts taking place in September looks increasingly likely. The Indian stock market was particularly positive following Narendra Modi's heading a new coalition government. The Nikkei share average rose by 0.55%. The Hang Seng Index increased by 0.3%. while the Shanghai Composite Index ended down 0.54%. Over in the United States, two major benchmarks hit record highs in U.S. markets last night. They were powered mainly by technology stocks, as well as recent U.S. data that suggests support for the much expected beginning of interest rate cuts. The Dow Jones Industrial Average rose by 0.25%. The S&P 500 ended the day up 1.18%, while the tech-heavy Nasdaq rose nearly by 2%. Well, it's a bit of a mixed bag on the JSE today. The all-share index is up 0.5% at 77,258 points. The industrial 25 index is 0.7% firmer, while financials have slipped by about 0.25%. Looking at commodities, gold is trading at $2,359 and platinum at $1,001 an ounce, while the price of Brent crude oil is standing at around $78.69 a barrel. The rand is trading at 18.98 against the US dollar, 24.24 vis-a-vis the pound, and 20.62 against the euro. Well, to break down the markets for us, I'm joined by Roy Matuni. He's a portfolio manager at Sanlam Investments. Thank you very much, Roy, for joining us. So global markets seem to be anticipating that interest rate cut for September, a 69% probability, they're saying. Why?
Well, that I think is a culmination of all the data that's come through. So what you're seeing is that the job market is not quite as tight as it was in the US, and all of these PMIs, or purchasing manager indices, that are coming out are not showing a particularly strong economy. Plus, the trajectory of inflation is in the right direction. It hasn't gotten where it should be, but it's in the right direction. So when you put all of that together, I think what the markets are telling you, or what investors are telling you, is that they believe at some point the Fed is going to figure that you're better off heading off a slow economy than being caught on the back foot and then having to cut aggressively.
Yeah.
But it's still a toss-up between September and November.
And tell us about the European Central Bank. It's largely expected that they're going to be cutting rates. Why so soon for them?
So they're on a different trajectory from the US. So economic growth is softer. Inflation trajectory is actually getting to the target much quicker. And for them, you're seeing wage inflation actually softening, which means that the services side of the economy is slowing down. So they're much closer. Previously, they all expected that the Fed would go first because of how strong the dollar is, and all other central banks were afraid of going before the Fed because that would impact the currencies. But it just seems that it is now inevitable, especially after we saw the Canadians go down by 25 basis points, that now even the euro will decide, the ECB will decide to go down a little bit as well. Yeah,
talking about currencies, we come to our very own. It's flirting with that 19 rand against the US dollar mark. It seems as though it continues to be under downward pressure. Is this all around the anticipation of, what a coalition government is going to look like, or other factors perhaps?
Well, if you look at the common factors that drive the rand, I think it will be difficult to think otherwise. So first, terms of trade are actually quite positive, and these generally tend to drive the rand stronger. The dollar's weakened. It's gone down from about 105 to 104, give or take, but especially since the election day. But the rand's weakened when typically it would have strengthened. So clearly there's a risk element embedded within the currency. I don't think the markets are calling for one or the other. I think it's just that this decision is up in the air, and it's been up in the air for some time, and we still have another week. So certainty is still some time to go.
Yeah.
So I think that's the underpin there.
So what's the story with commodity prices these days? I mean, what's been driving them?
Well, actually, what you saw is at the beginning that that gold had rallied and copper had rallied, but they seem to have found a top. Remember, commodities are driven largely, they're driven by demand from investment, fixed investment, particularly in China. China consumes, I think, 50% of all industrial commodities, and they were only recovering very, very slowly. And what you've seen in more recent times is that the recovery has picked up pace, not quite at the level that the market was expecting, and that's put a bit of an underpin on things like copper, iron ore, and coal, but not enough to go into a whole new cycle. So when you look at companies like Trafigura reporting, they seem to have had the best of the commodity cycle last year, and they see it slowing down this year. When you look at all our companies here, the platinum price doesn't seem to have picked up or accelerated to any great extent. So it's very mixed, it's very commodity specific, but I think the underlying theme here is that you don't have excess growth currently in the economies, and I guess that's also why we're looking towards cuts in interest rates to try and stimulate economic activity. Maybe now inflation is behind us, it's time to look for growth.
So we do see that the local equities market has also been quite volatile. Today it seems to be on the up, but generally the bias is down as, you know, investors sort of hold back as they wait and see what happens in terms of the coalition government. But what's your view around, you know, sectors or specific stocks that you think would be worth investing in on the JSE right now?
So what we're seeing right now is that there seems to be a bias towards commodities, rand hedges, or anything that benefits from a weaker rand. And then the domestic stocks that are predominantly determined by what happens here seem to be selling off, such as the banks, Bidvest, and some of the smaller caps. I would say investors would be well rewarded if they started looking at these companies. The banks are highly liquid, they offer strong, solid dividend yields. They're very diversified. Yes, they're tied to the fortunes of the economy here, but this economy is not going anywhere. And over time, they've shown that they're pretty resilient despite what the macro or what the politics brings along. That's where I think you probably will see value. I think the crowded trade right now is those rand hedges and some of the commodities that are benefiting from a substantially weaker rand.
Roy, thank you so much for your contributions. As always, Roy Mutuni is a portfolio manager at Sanlam Investments.